The easiest way to understand directional bias or to find the bias of the market is to understand market structure and liquidity. So now, when you have a bullish structure, like this one here I've shown you, most of the time when market is retracing, it's normally retracing to an internal range liquidities. And these internal range liquidities could be fair value gaps or order blocks. Most of the time that is where the market will retrace to. Again, so how do you know the market is ready to retrace? Anytime we make a higher high, in this case here we have broken structure to the higher side. So the moment we've made a higher high, we mark internal range liquidities on this leg that made a higher high. So internal range liquidity can be here. Maybe you can have like a fair value gap here. So you mark your fair value gap here. And the next thing you're expecting, you should be anticipating that the market will retrace to this internal range liquidity. So if your higher time frame in this case, if this is a weekly structure and we've marked our internal range liquidity here, so our narrative is going to be at this point that the market is bullish. However, we are at a point where the market might retrace to this internal range liquidity. And market retracing to this internal range liquidity, this might even take 2 weeks. So you have two bearish weekly candlesticks that will retrace to this internal range liquidity. So in that case, your narrative or your bias and the structure is we have a bullish structure on the weekly time frame. However, when we move to the daily, in the lower time frame. For the next 2 weeks, we are going to have a bearish bias because we are retracing to an internal range liquidity of our higher time frame. Then once price gets to this internal range liquidity once more, at this point we expect that the market should respect it. Then again, now we'll be targeting what? We'll be targeting this external range liquidity as our next draw of liquidity. And I want you to know something. When you have a higher time frame structure, if you move to the lower time frame, the way the structure looks on the higher time frame and the lower time frame is totally different. So in this case, when you're having this retracement, the weekly candle retracing, if you move to a lower time frame, you will find that the lower time frame is a whole bearish structure. So you'll find that the lower time frame is a whole bearish structure. The market is making lower lows, lower highs, lower lows, lower highs until we get where we get to our weekly internal range liquidity. So then you're going to trade bearish and you're going to use our bearish PDRAs. You get your setups from here and then we get the bearish move until finally price gets here. When price gets to our internal range liquidity of the higher time frame, at this point here, our bias now is bullish, and the narrative is the higher time frame, the structure is bullish, and we were retracing to an internal range liquidity. So the price has already gotten to an internal range liquidity, tapped it. Of course, we are going to look for confirmations on the lower time frames. Once we get our confirmation that this market is now willing to start going bullishly, now our bias from this case is bullish until we get where? Until we get to this external range liquidity, which can be here now, if you look at it from the lower time frame. So now, at this point here, again, what are we doing? Still using internal range liquidity and external range liquidity. At this point here, first of all, you're going to get market structure shift on the lower time frame. That's the first thing that you will notice. Now, this is a lower time frame that now is in line with the higher time frame. We are now going to make a higher high on the weekly, which is our higher time frame. So then we mark our internal range liquidity. So now we're expecting that price will retrace to this internal range liquidity and take advantage of this move as we go make another higher high. And then once we break structure again on this time frame, what do? We mark again internal range liquidities here and anticipate that the market again will retrace what to this internal range of liquidity. It might take 1 day or even 2 days to finally get here, and then you get another higher high that might take 2, 3, even 4 days during the week until finally price gets here. So you see, you're going to have 2 full weeks of trading bullishly, or even 3 weeks until price gets to this external range liquidity of the weekly. So I want us to look at examples on the charts. Before we proceed, intermediate or advanced traders, starting August 12th, I have online classes. WhatsApp me using this number and register for the August 12th classes. So this here is a GBP USD chart and this is the monthly time frame. So we're just starting from the higher time frame. We're going to go all the way to the lower time frames. So clearly you can see here we've been bullish, we made a higher high, we had that retracement, we made another higher high, we got a retracement, and now we've made a higher high. And one thing that you can see, the moment we make a higher high, we expect a retracement to happen. Again here, the moment we made this higher high, it looks like a retracement could be happening. So that is normally the first thing, like I told you. Anytime we made a higher high or a lower low, anticipate a retracement. So now, this last leg that made a higher high, which PDRs do we have on this leg? So the first thing we have is we have an order block. These bearish consecutive candlesticks, you can see we closed above it. The moment we closed above it with this candlestick here, this here is an order block. So all this is an order block. You can mark it like that. Then apart from the order block, once more, on this leg still, yeah, our internal range liquidity here is we also have a fair value gap here. And this fair value gap is still just literally inside this order block. So which means um, when we're getting our retracement to our internal range liquidity, we are likely to get to this fair value gap before we continue with the bullish move up. Or price might just retrace from here on this order block. But the best case scenario is price retracing to this internal range liquidity, and then we continue with the bullish move. So you can see here where we have our fair value gap is 50% of this dealing range here, which is good because that will be at a discount price. So you can see this bearish candle. This is the start of the retracement. So let's even move to a lower time frame and see what this looks like. So if you move to the weekly, you can see this is 3 weeks of bearish candlesticks. You can see we had that bearish moves, and then here we had this fair value gap that price retraced to. So let's even move to even a lower time frame. So the retracement that we just saw on the weekly, you can clearly see on the daily, these are so many days where the market was bearish. So which means our directional bias in this case would have been bearish for a very long period of time. Then, when price was retracing to the weekly fair value gap that we just showed you, you can see these are how many days where the bias would have been bullish. These are so many days because we were retracing to a higher time frame key level. Now we can even now move even further to another lower time frame. Let's see the 4 hour. So that retracement that we saw on the higher time frame, you can clearly see this is a full bearish structure on this 4 hour time frame where we've made king lower lows, lower high, lower low. Then the few days of retracement to this weekly fair value gap that we just saw, you can clearly see on the 4 hour again, this is a full, we have a market structure shift and we change a full structure, bullish structure, as we were getting retracing to where to this weekly fair value gap.